The U.S. national debt just passed $36 trillion. Interest payments are now higher than defense spending. And the Federal Reserve? It's losing over $100 billion a year while trapped between inflation and insolvency. Can the U.S. survive this debt crisis, or are we heading for a fiscal breaking point? Hey, I'm Robert, and this is The Alternative Investor. Today, we're digging into one of the biggest threats to our economy that no one wants to talk about: America's debt spiral and the Fed's trillion-dollar dilemma. We'll break down what's really going on with the national debt, why the Federal Reserve is bleeding money, and how this could reshape markets, inflation, and your investments. The national debt has officially crossed the $36 trillion mark, and the government is now adding more than $1 trillion in new debt roughly every 100 days. That pace is historically unprecedented and deeply unsustainable. Projections from the Congressional Budget Office show that the debt-to-GDP ratio is on track to exceed 130% within the next decade, putting the U.S. in a fiscal danger zone typically associated with developing nations, not the world's largest economy. One of the most alarming aspects of the current debt situation is the cost of servicing it. Interest payments alone are expected to reach $1.6 trillion per year by 2033, which would make them the single largest line item in the federal budget, outpacing spending on Medicare, defense, or education. This level of interest expense isn't just a budget issue, it's a structural threat to the long-term solvency of the United States. Many Americans ask, why not just stop the reckless spending? But it's not that simple. Over 60% of federal spending is mandatory, meaning it's locked into entitlement programs like Social Security, Medicare, and Medicaid. These programs are politically untouchable, especially during election years. Attempting to cut or even reform these programs would almost certainly face massive public backlash and political suicide for any administration brave enough to try. On the revenue side, tax receipts aren't keeping pace with spending. And despite the debt problem, there's broad resistance, especially in an election cycle, to raising taxes. No politician wants to campaign on taking more from people's wallets. This leaves us stuck with trillion-dollar deficits year after year, even during periods of economic expansion. The government is borrowing not to invest in the future, but just to keep the lights on. Now let's shift to the Federal Reserve. After aggressively hiking interest rates to combat inflation over the past 2 years, the Fed now finds itself in an unprecedented financial bind. And here's the trap. If the Fed cuts rates to reduce its own losses, it risks reigniting inflation. But if it keeps rates high, it deepens its own losses and threatens the fiscal health of the United States government, which now owes more than ever. The Fed is completely boxed in. The rest of the world is paying close attention to this dynamic and starting to act. Countries like China and Japan, traditionally the largest foreign holders of United States treasuries, have begun slowing or even reducing their purchases. This signals growing concern about America's fiscal trajectory. Meanwhile, a coalition of countries known as BRICS, which includes Brazil, Russia, India, China, and South Africa, is actively exploring alternatives to the United States dollar in global trade. That's a massive challenge to dollar dominance. Additionally, central banks across the world are buying gold at a record pace. Why? Because gold is seen as a hedge against both currency risk and sovereign default. If global faith in the US dollar and treasuries continues to erode, borrowing costs could rise even further. That would only accelerate the debt crisis and potentially lead to a long-term shift in global financial power. This doesn't mean a market crash is happening tomorrow, but it does signal structural shifts that investors need to understand now. The most likely path forward is a continuation of current trends: more borrowing, more money printing, more financial engineering, and eventually, a weaker dollar as purchasing power erodes. So what can investors do to protect themselves? First, it's time to diversify beyond traditional equity indexes. That means owning real assets like gold, commodities, and even select real estate that holds up during inflationary periods. Second, look for income-generating equities. dividend-paying companies in defensive sectors like healthcare, utilities, and consumer staples. These businesses tend to perform well when growth slows and inflation lingers. Third, shorten your bond duration. Long-term bonds get hammered when rates rise, so shifting to short-term treasuries or floating-rate notes can help preserve capital while still earning yield. Fourth, consider inflation-hedged investments like Treasury inflation-protected securities, TIPS, commodity ETFs, or even Bitcoin, depending on your risk tolerance and philosophy. And finally, if you're an active investor, learn basic options strategies like covered calls or cash-secured puts. These tools can generate income and hedge downside without exiting positions completely. The era of easy money is over. Going forward, it's not about maximizing returns, it's about protecting wealth and positioning smartly for volatility. So, can the US survive this debt crisis? Maybe, but not without massive changes to how we handle spending, interest rates, and the very structure of the global economy. The Federal Reserve is boxed in, Congress is paralyzed, and the rest of the world is watching closely. The dollar may still be the dominant currency, but it's no longer untouchable. The real question is, are you prepared? If this gave you something to think about, hit like, subscribe to The Alternative Investor, and let me know in the comments, what's your plan if the system cracks? I'm Robert, stay sharp and stay positioned.